the Colorado League of Charter Schools webinar series. This session is focused on owning your own facility or campus for your charter school, and the intended audience of this presentation, generally speaking, is for younger schools and startup schools, so we'll try and keep it focused on that vein, but we may also just talk generally about financing throughout the presentation. My name is Matt DeAngelis, and I have my colleague Eric Duran with me here in the room. We work for D.A. Davidson, and we are investment bankers who finance charter school facilities and help schools figure out what the best options are for them and execute those options. After listening to this presentation, if you have any questions, you of course should reach out to the folks at the League. They're very helpful, or you can reach out to us. Our contact information is provided, and we'd be happy to talk to you about any ideas or questions you may have. All right, so trying to keep this from being as dry as possible. So the cartoon says, "I can't sleep. I just got this incredible craving for capital." Candidly, the facilities question is one of the hardest questions for charter schools. That's one of the biggest struggles that charter schools have, is securing their own facility and financing it. And it is one of the things that can keep administrators, founders, board members, business managers up at night, because it's really important to find that facility and have that long-term home. Going to the next slide, so there are more financing options than ever before for charter schools, and depending on the school and the life cycle of the school, some of these options are viable and some are not at those times, and some make more sense than others at certain times in the school's life cycle. So we will go over each of these options in high-level detail or overview throughout this presentation, but from a perspective of a school, there's definitely pros and cons of each structure, and definitely things that need to be considered as the school's evaluating its options. And so we'll try and give a high-level overview of each of these today and help you kind of get a general understanding of the pros and cons and things you should be thinking about as you're looking at each of these options. Eric, would you like to talk about why schools borrow?
So obviously charter schools, unlike traditional district schools, have to pay for or lease their own facilities. So I think it's first and foremost, you want to own your facility, escape a landlord, and don't want to face rising costs. It also embeds you in the community, your families, and people that you work with know where you're going to be at. Number two, it can be less costly over the long term. It locks in your facility costs, just like when you purchase a home, it locks in your mortgage payment for 30 years. So does it on the bond side or on when you're doing facility finance. So that way, hopefully, your per pupil revenue goes up and your payment stays the same. Number three, it allows the schools to develop its property and around its programming. If you have a specific need, if you're a Montessori school, if you're a expeditionary learning, you can develop your programming around your facility. And fourth, it allows the school to build equity over time in their facility and improves your balance sheet. The reality is when you lease a facility, you don't really own anything and you aren't really paying down anything or adding anything to your balance sheet. So from a financial standpoint, it makes a lot of sense for a charter school to own their facility. Lease to purchase, what is it? It's when a third party is hired to build and own the facility, and then you enter into a lease agreement with the school. The school has an option to eventually purchase the facility at a later date, typically in 2 to 5 years. There's some pros and there's some cons to this approach. First, the developer takes the construction risk. They make it nice and easy for you. They've built other charter schools perhaps and know what they're doing, and it's just sort of a turnkey option. The developer's typically willing to execute the project for its school when you're relatively new and in your infancy. So you may not even have any kids at this point, and the developer will be able to build it anyway. It allows the school to have a new facility as opposed to leasing in a shopping center or trying to run down a specific facility. And it has an impact on, and then you can have input on the construction and the type of building. So those are some of the pros. There are some cons, obviously. Typically, it's the most costly option available when you're working with the private developer. You don't develop any equity. You really don't own the facility in these early stages. You're just leasing it. So it's just like you're leasing in a shopette. Third, the cost of construction, eventually acquiring it from the developer, can be very, very costly. And finally, the quality of construction can be substandard. These are developers. They're trying to make as much profit as possible, so sometimes they may cut the corners in the construction process, and the facility may not be as nice as you may want it over the long term. Nonetheless, it can be a useful bridge to permanent facility for some schools in some rare instances. It is not the preferred method to work with the private developer, but in some cases it may be your only option. The next slide is with regard to CDFI. CDFIs are Community Development Financial Institutions. They're typically nonprofits that can provide loans to schools for purposes of constructing a facility that will fit their specific mission. That is the Community Development Financial Institution's mission. Some of their missions are to help in urban areas or low economic, socially depressed areas. They're all sort of mission driven. Some of the pros on this: they'll finance schools in their infancy as well as higher risk financing. The cost of capital can be lower than what would be available under a private developer scenario. Certain of the populations are viewed as very favorable by the CDFIs. For instance, rural versus urban. Some have very specific goals related to specific minority groups. So it can be easier in the loan process and make funds available. Some of the cons. In a lot of instances, these community development financial institutions can be just like banks and just as difficult to work with as banks. They can be subject to a maximum loan-to-value ratio, requiring the school to put up equity or cash. So if your project costs $10 million, in some instances, these CDFIs will require the school to bring in $2 million of either their own equity that they can contribute or from subordinate debt, which can make it difficult to work with a CDFI. Typically, they can only loan up to about $10 million, so their funds are limited. And finally, their short-term bridge financing requires the school to look for other options in 3 to 7 years. The bottom line on CDFI loans is they're a good option for certain schools to obtain access to a limited amount of financing, which can serve as a useful bridge to permanent financing. Generally, these are schools that are in urban areas or rural areas or a specific, very specific targeted area. It may not be applicable for all charter schools. Only a limited set may have access to this resource. I'll turn it over to Matt to let him go over to EB-5, Visa Loan Program.
Yeah, so the EB-5 program is created by our federal government as a way to stem or create foreign investment in the United States. And in return for creating this foreign investment or taking risk and putting money into projects that otherwise may not be invested in, these investors, foreign investors, can receive a visa to come and live in the United States permanently. And so this is something that is being used by charter schools now as a way to fund projects, and the key to this program is that the project must create jobs. And so typically a new school or a growing school creates additional jobs and therefore qualifies for the EB-5 visa program. One thing I would say about the EB-5 visa program is it's not a source of 100% financing. It's usually a financing source that is coupled with a tax-exempt bond or with a CDFI loan or with some other type of bank financing potentially, and is used as a subordinated loan. So it's subordinate to the loan that is senior, which may be that bank financing or bond financing or some other source of financing, but it's a way to bridge a gap, so to speak. So as Eric mentioned with the CDFI, sometimes they'll require that you bring 20% to the table, and so this EB-5 visa is a subordinated loan, so it could be that source of capital. Again, they're focused on schools that are growing, and so they're focused on schools that are either young or brand new, and so they're eager to do startups. Unlike most lenders, they do want to work in that space. And like I said, they can make up those loan-to-value shortfalls. Cons, it's typically not 100% source of financing, so you're coupling financings together, which can be very time-consuming and expensive and difficult. And then the school must be located in what they call a qualified census tract. So that's there's a website that you can go to and find out if your school qualifies. But typically, it's areas that are suffering and aren't meeting or aren't on par with the rest of the economy nationwide. The financing can take at least 6 months to close, and candidly may take 6 to 9 months in the recent market, just due to changes in the EB-5 visa program. And again, it's a short-term source of financing. It's typically a 5-year hold period. They have to stay in the deal for a certain amount of time because the jobs count occurs in year 3, and that's the key to them getting the visa. But either way, they're not a long-term source of financing and need to be refinanced at some point in the future. Again, bottom line, it can be a helpful tool to bridge a gap when you need a subordinated lender. But you definitely want to plan ahead if this is something that you think you may need, because it's not going to come quickly or easily. Bank financing, everybody knows what bank financing is. Everyone's been to a bank to get a loan for a mortgage or for some other purpose for their business or for personal reasons. However, a new development in the capital markets and in our world is that banks are now interested, in some cases, in buying tax-exempt bonds. And so these deals are structured as tax-exempt loans where the bank is the investor buying the loan and then lending the funds for the school to build its project. I think, this has grown out of limited loan demand in other sectors over the past since 2008 when the Lehman Brothers blew up and the markets kind of came to a freeze. And as a result, banks started looking elsewhere to deploy their capital and found this charter school market as well as other tax-exempt bond markets as a way to deploy some of their capital. Loan demand is picking up in their traditional sectors, so we've seen commercial banks pull back from what they were offering just even in 6 months to a year ago. So the market's very volatile and fluid, and there's always change, but there are some banks who are interested in financing facilities, and they can be a source of capital. I think the cons associated with bank financing is, again, it's subject to a loan-to-value ratio. So if you are buying a building and you don't have any equity in the building, and of course you're a relatively new school or a brand new school, you're not going to have a bunch of cash to put down towards your facility. So it can be really hard to meet the requirements that the banks typically put on their loans, or always put on their loans, frankly, for charter schools. And again, they're short-term loans. They're not 30-year commitments. They're typically anywhere from 5 to 15 years. So the loan is subject to refinancing risk, and what's expected to be a rising interest rate environment. It's something that may look attractive in the short term, and it could be a good deal, but in the long term, you may have to refinance, and rates may be much higher when you do so. And the last thing I guess I would say about banks is that their loan process is it's kind of archaic. It's really hard to know what the options are and what they really are able to provide until you get far down the path. So you want to, again, plan ahead, because banks may be willing to do a financing, but you want to make sure you allow for a lot of time to explore that option, because it can take a very long time to get a commitment from a bank. In fact, we worked with a school last year who spent 8 months trying to get a bank financing secured, and ultimately the bank decided they did not want to do the financing. And then we helped them out, but that was 8 months wasted before they got to that point. So just keep that in mind as you're thinking about bank financing.
Tax-exempt bond financing, what is it? Well, I mean, I think people get overly confounded with what the bond process is. And it's very simple. It's a form of financing for charters as nonprofit quasi-governmental entities. In other words, it's simply a loan to charter schools. And it's a loan that's cut up into, $5,000 denominations and sold to institutional investors. So it's really nothing more than a loan, a tax-exempt bond financing and bonds. There are a lot of pros to tax-exempt financing. It can finance 100% of the project costs with no loan-to-value requirements. This really sets it up different between CDFIs and traditional commercial banks. Second, it's a commitment term of up to 35 years, fully amortizing, and there is no refinancing risk. Again, it distinguishes from CDFI and bank loans. Interest rates continue to hover near historic lows. I think that's also true with other products that we've talked about today. More lenient covenants than other forms of financing, which allows for future debt and expansion. There are some cons to bond financing. It typically requires some operating history, although there have been a handful of national investors willing to provide financing for startup and expansions. So you should talk to your financial advisor or underwriter and if this is an option you're going to look at if you're earlier than 1 or 2 years in the process. Typically has higher costs due to the commitment period. You're actually getting 30-year financing, so it costs a little bit more. The process usually takes 60 to 90 days. Bonds are typically not callable for 10 years, so once you're in a bond transaction, it is difficult to refinance out. Bottom line, bond financing provides low-risk, long-term capital to schools with operating history, and the market continues to expand, allowing more schools to access this market. And it is in excess of 100% loan-to-value. Is a lot easier in a lot of regards than pursuing bank financing or some of the other options. The bond market continues to expand. There have been over 800 transactions that have been financed dating back to 1998, totaling in excess of $10.4 billion. 95 bond issuance in 2004 alone in excess of $1.8 billion. You can see that on that chart. USDA loans. What is a USDA loan? Schools are generally located in rural areas that have populations less than 20,000. They can obtain market rates that are below what you could get from a traditional bank. And there are two types of USDA capital projects. One is the direct loan, and two is the guarantee loan. Obviously, a direct loan is one made directly to the school. A guarantee loan is when they're working with some type of bank, and the USDA guarantees the bank loan. There's pros and cons to this as well, as obviously. First, on the pros, the direct rates are offered can be well below 4% and can amortize up to 40 years, and these rates are well below current market rates. The guarantee program can be used to refinance existing debt. So in the direct loan, you get the 40-year financing. In the guaranteed program, you can only use it to refinance your existing debt. Those rates are not quite as attractive. Schools may not qualify for other types of financing due to their location, their credit profile. Their location may be in a rural area, and that's a good thing about the USDA program. Some of the cons with regard to the program. Guarantee terms are not as competitive and may require the lender of record to lend funds directly to the school. So that's in the guarantee program. That's one of the cons. In the direct program, which is the most attractive, it can only be used for new money projects and can't be used for a refinance of an existing facility. And it would require an interim bank financing during the construction process. One of the cons to both programs, is that the loan process can take 6 to 12 months, and there's a lot of uncertainty as you're dealing with the federal government. Bottom line, USDA direct financing is the lowest cost financing available to charter schools. However, obtaining it requires a competent team committed to the effort, and you need to be aware of the program restrictions.
now we thought it would be helpful to do a case study, a real-life case study for a school. I'm on the board of, this is New America School. We have 3 campuses in Colorado and 2 in New Mexico. And so New America School has a campus in Thornton, and it was previously in the Mapleton School District. We were leasing from the district. Highly transient population at New America School, not your typical, charter school. We don't serve the typical student. We serve students who are dropouts, may have had, they're high risk, let's just put it that way. They're high risk in some form or fashion. A lot of immigrants, English as a second language. So just a different student base than a typical charter school. And so we had been leasing a facility for a long time. It wasn't great. The school was kind of struggling because of its facility and just its general location, not in any sort of neighborhood area, very industrial area. So we decided we wanted a new facility. We looked around and identified a property a little ways away from our campus at the time, and we entered into a lease purchase agreement with a developer. We were not creditworthy enough to do our own financing right away, and so we decided to go the lease purchase option, recognizing that it was more expensive, but that it was our only means for getting a loan, because the other options were just CDFI was off the table. Okay, so now we thought it would be helpful to take a real-life example, a case study of a real school and what they've done. This is New America School. I'm on the board of New America School. We have 3 campuses in Colorado, 2 in New Mexico, and this particular financing has to do with our Thornton campus today. The history behind it is the school is focused on high-risk students, English language learners, immigrants. So it's a very transient population. It's not a typical school. So while we opened in 2005, we just don't have a lot of credit history, and we were leasing a facility for Mapleton School District in a very commercial area, not a neighborhood feel at all. And so, candidly, it wasn't the best situation, and the students weren't happy there, and we weren't happy there. So we felt like we really needed to find our own home and build our own home. And so we identified a property a couple miles north of where the school was in a much better area, and decided to make that our new home. However, at the time that we went to do the financing, we were not a creditworthy institution. We were not a school that could go out and issue its own bonds. And most of the options really weren't options for us at that time. We couldn't get bank financing. We couldn't get CDFI loans. EB-5 wasn't an option. Grants, USDA wasn't an option because we were not in a rural area, we're in an urban area. And so our option was to do a lease to purchase transaction with a developer. So the developer, built us a building, and we entered into an agreement with him where he purchased the building, he renovated it, and then we are currently leasing it and plan to acquire from the developer at some point. So what did we do? We went through a long planning process. We ended up having the developer purchase an old Albertsons approximately 2 miles north of where we were at the time, and then the developer in turn renovated it and turned it into a school for our use. At the time of the financing or the time of the lease developer transaction, there was significant risk. Our school was 300 kids. It wasn't flourishing at its current site, but we knew it had the potential. It just was not in a good location. It was not a place kids wanted to come. So we said, okay, this site is 2 miles away. We have a transient population. Are this kids going to follow us to this new site? And then one of the other risks at the time of financing was that we closed on the financing in May, and then the school moved mid-year in January of 14. So it was a May 2013 close, gave us just 7 months to do the construction, and then we moved over winter break from our lease campus, our old campus, to our new campus, and immediately kids came. So we went from 300 kids to 400 kids really quickly, and facility opened on time and on budget. The morale of the students changed fundamentally. This is a piece of the community. The mayor of Thornton is very proud, has endorsed us and gone on the record. So it's just a different place than it was, and a lot of it has to do with the facility and giving these kids a home. So now, what's next? We don't want to lease forever. Obviously, we want to start building equity. So this year, 2016, becomes the first year that we can buy the facility from the developer. So our goal is to do that in the near future. I think the project was successful for a lot of reasons, but a lot of it had to do with planning, and, looking at different options, looking at scenarios, playing out the downside risks. What if enrollment doesn't increase? What if enrollment goes down? Whatever those risks may be, we looked at all of them, and we analyzed them to see if we could still afford the facility. And then we also, we engaged all of the advisors, because we recognized, while this is obviously part of my day job is the financing of charter schools, or that is my day job, there's a lot of other things that need to be handled in this process. So we had financial representation, we had an owner's representative, there was a bank involved, the developer was obviously involved, there was an equity provider. So all of these people were involved, and more important than anything else was that financial and owner's rep. So having someone on your side through the construction process and working with the developer and ensuring that everything is built to spec and that they aren't cutting corners or trying to save money, all of those things are just huge in terms of making sure you get what you want and that it doesn't go over budget and it's done on time. And then obviously on the finance side, you just want to make sure you do something that makes economic sense and is something that you can afford, because we've seen a lot of schools get into developer deals where they really are never going to be able to buy their facility because it just economically will never work. So, in that risk mitigation process, we wanted to make sure students were going to come, so we spent a lot of time surveying students to make sure they wouldn't, leave the school if we moved. We talked to a lot of the families in the new neighborhood. We talked to the mayor of Thornton as well as the district, and, we just got comfortable that everybody was on board with our project, and we had all the stakeholders, and everybody was invested, and we weren't going to be hung out to dry. And then we also aligned our interests with the developer to make sure that there was an incentive for them to do everything on time and on budget, and we rewarded them for such performance. So I guess the question is, why do you want to do financing number two? Obviously, the first thing is it saves the school money, and it builds. Well, the first thing is that you get to build your own equity in your facility, so you're owning it instead of leasing it, as Eric mentioned earlier. But then the second thing is, the lease rate is much higher because the developer's cost of capital is higher than the tax-exempt bond market. So, our lease is basically at 12% of the cost of the facility, and the tax-exempt bond market benefits from tax exemption, and investors are willing to accept lower rates because they don't have to pay taxes on the interest earned. And so, we don't know the exact rate, but even if it comes in at 7%, we're still saving 5%. So it's just it's an economic decision as well as a ownership decision, and it will help reduce our facilities costs on an ongoing basis and fix it for the next 30 years. Trying to lighten the mood here. Okay, folks, let's move along. I'm sure you've all seen someone qualify for a loan before. This couldn't be more true for charter schools. I mean, it's really hard for schools to go to a bank and get a loan, or go to a lot of these organizations and just ask for a loan. It's going to be nearly impossible for a startup school to get a loan without good foresight and planning. And so I think that's where we want to move next, is to talk about, what is it that schools need to do? What are the things you should be thinking about today as you're starting your school, as you're in your first couple of years of operation, to make sure that when you are, that in a couple of years you're ready to go, you can actually go get financing to build that facility that you want to build. And if you don't do the right things in your budgeting process today, it's going to be impossible or nearly impossible to get financing in the future. So it's all about planning.
All right, the 4 keys when you're, as a new school, here's the 4 keys that you need to be thinking about as you prepare to eventually own and purchase your own facility. First and foremost, cash is king. Strong liquidity position is paramount to obtaining the most attractive financing terms. In August 2015, S&P's investment grade medians for days cash on hand was 111 days. In other words, if you paid all of your bills, everything off, and you just had some cash left over, how long could you afford to operate your school? Or another way of thinking about it is, if state aid payments were to stop, how long could you afford to operate your school without, having any more money left? So if you're going to aspire to be a BBB minus credit, which is, the highest grade credit you can get for a charter school, it's 111 days. But in general, we've seen schools get financing with days cash on hand as low as 30 to 40 days. So you just want to be in the positive realm. 111 days is more of an aspirational thing. Number 2, operating surplus is key. Pro forma coverage in excess of 1 times. In other words, when you operate your school on an annual basis, you want to have some money left over at the end of the year. In other words, you are putting cash onto your balance sheet. So in other words, you can operate after receiving all of your revenue and paying all of your expenses on an annual basis, you want to have some money left over. This will demonstrate that the school has a track record of cash flow, which means that it's predictable and can operate efficiently. So operating surpluses are important. Third, this is what we all get up for and what the educational movement is all about. Your program needs to be strong educationally. Good test scores relative to your peers and good growth relative to your peer group in your community are important. You want to make sure that we're fulfilling the charter school mission, which is we provide a better educational choice than what is traditionally out there. So you want to have good, strong educational performance. 4, plan certainty. Lenders despise uncertainty and prefer projects that improve finances of the school. So before you enter into anything, you want to know that you can afford what you're trying to purchase and that you'll be able to operate it and live within your means. We think if you do those 4 things and you are running your school well, that you're going to be able to have a lot of options and have attractive options. Ratings in the bond market. We talked a little bit earlier about bond financing. Obviously, every single charter school is different. Everyone serves a different program, a different demographic program, has different operating history. And so when you're looking at bonds in particular, not everyone will get the same interest rate. Some schools have good credit, other schools are new and have less credit. So about half of the charter schools issue non-rated bonds as a result of that, and half of them obtain some type of rating from a rating agency. Charter school bonds typically fall into one of two categories. Triple B is the highest category that we've seen a charter school get rated based on its own, triple B minus is the highest rating category that we've seen for any charter school. But more than likely, most of them are in the double B or non-rated category. We have all of the ratings laid out in below in the chart. Investment grade ratings are to the left. Non-investment grade credit ratings are to the right. Generally, a school only wants to get a rating if it's double B or higher. If it's below that, you're better off just doing a non-rated transaction. On the investment grade spectrum, the highest a charter school, based on its own credit, is able to achieve is triple B plus. Any of those to the left would be with some guarantor like the state of Colorado or some state agency making some type of pledge that they will stand behind the charter school's credit. Otherwise, it's not likely that a charter school will get a rating above the triple B plus rating category.
Yeah, and in Colorado, we're lucky to have what's called the State Moral Obligation Program. And how that works is if a charter school can obtain at least a triple B minus rating, then it can use the state's moral operating, which is an A rating, for its bonds. So as a young school, you're not going to qualify. You're not going to be able to get to an investment grade credit in a year or two. But it's a long-term goal, and it's something that allows you access to the lowest cost of capital that's really out there for charter schools besides USDA loans. So, for example, in the current market, moral ob transactions are 30-year financings around 4%, a little over 4%, fixed rate for 30 years. So it's not something that's an imminent focus today, but it is a goal that all schools typically have, and something that they work towards and strive towards as they grow up and mature.
And most schools will start out in the non-rated category. Non-rated deals are being done for schools that have a one-year operating history, in some cases startups. Those rates have a wide range. They can range from 5.85 all the way up to 8% in some cases.
And so as you're thinking about the future of your school and what things you should be focusing on, there are medians that are published by the rating agency that rates charter school bonds, which is Standard & Poor's. They publish medians every year, and in those medians, they kind of give you an overview of what does a triple B minus school look like, what does a double B plus school look like. And again, these are medians, so they're not end-all be-alls. You don't necessarily have to check every one of these boxes in order to be in that category. You may be better on some things and worse on others, but it's just a good general benchmark or guideline to what these schools look like. So, for example, if you look at the median for triple B minus enrollment, it was 771 students in fiscal year 14. Their debt service coverage, so meaning when you take your revenues and you net revenues after paying your expenses, and then you see how much money you have available for debt service, and you divide that by your cost of your facility or your debt service payment for the year, you have 1.5 times coverage. That's the median for triple B minus. So you're basically 50% cushion. And then there's other metrics. All of these are kind of the key metrics, or some of the key metrics that S&P focuses on when they do their analysis. So these are just things that you can think about and focus on as you're working to build your school's financial profile for the future. And there's certain definitions of how these are calculated, so it's pretty specific, and we're happy to help if you have questions about how to calculate any of these ratios for your school. So if you have questions, we are easy to get a hold of. Of course, you can reach out to the folks at the league, and they can help. And then if you'd like to talk to us directly, here's our contact information. Beyond these slides, which I think will be available to you all, there's a lot of information about the rating process in school, the characteristics of schools as they go into the rating categories and get rated by S&P. And there's also just a lot of other helpful information that may be of interest to you as you're thinking through your issues. I think the thing to take away from this is that there's a ton of options, and there's a lot of people who are going to come talk to you and tell you that there's one option is better than the other. but really you just need to make sure you're informed and do your due diligence and hire the right folks to help you through this process, because it's a very complicated process and it can be very time consuming and can lead nowhere if you don't plan accordingly and have the right folks helping you through that process. So, with that, Eric?
So D.A. Davidson's a full-service financial firm, and we are well-versed in all of these options. Today we've tried to provide you general information to give you a feel of the opportunities that are available out there. Obviously, you will need to talk directly to the consultants that are working with your firm or working with your school. None of this was specific. Each school is different. Each option may have different applicability, but D.A. Davidson is just providing this information in a general sense. Please discuss specifically with your own consultants or financial advisor. As I mentioned, D.A. Davidson does provide financial advisory services, underwriting services, and is available to talk about your specific issues if you need us.